Hi, I'm Jimmy. So this Alibaba stock analysis is the final collaboration, for now, with our friends over at the Everything Money YouTube channel. Now, as you may have noticed if you saw any of our very recent videos, well, we have somewhat different styles, video styles, but our core investing beliefs are very similar. So if you haven't done so yet, please click on the link in the description below to the Everything Money YouTube channel. Check out what they have. It's really good. Okay, so let's jump into the Alibaba analysis. And if you haven't seen my more recent Alibaba analysis that I did alone, I'll leave a link at the end of this video to that analysis. Okay, let's jump right in.
Guess who is here? It's Jimmy. Jimmy Capel from Learn to Invest. Welcome, Jimmy.
Thank you for having me.
Thank you for coming.
Jimmy.
Hi, I'm
Thank
Jimmy.
you for having me.
That's what the people want to hear. You know that, Jimmy. Jimmy drove all the way here. We're in Akron, Ohio. Jimmy and Craig drove all the way here to join us because this is the big show. What all of you have been asking for is a head-to-head between Paul and Jimmy on their thoughts on Alibaba. What a stock, Paul. What a company, and what a crazy story they're going through. We have gone through the ups and downs with Baba. We had our hesitations. Paul, when we did a video, I think one of our first come to Jesus moments with Baba, we started falling in love with it around 200, 194, the ticker price. And you were saying back then you're writing puts at 150. You hope it drops to 150 and all the way down to 100. And sure enough, we have hit that mark. Today is, what is today? The 22nd of September, 23rd? I don't even know.
We hit, and we're at 21st, and we're at 150 right now.
150. Paul, Jimmy, let's go back and forth. Your thoughts on Baba as general? What should value investors out there be thinking when they're buying potentially and this puppy's still going down?
You're talking about the best company to come out of China. It's the Amazon of China. Everyone there has access to them. Alipay, everything. It's being over-dramatized by, first, the Chinese regulations. China's not going to shut this thing down. This is the best company to come out of China. China wants to be more capitalistic. This is not going to be shut down at all. It's just an over-dramatization on top of the real estate company. Was it Evergrande?
Yep.
Evergrande, something like that.
Whatever.
Their debt's being called. It's going terrible, and it's just probably an anti-China thing. Now, I was always apprehensive about China. The reason I'm okay with Alibaba is Charlie Munger trusts Alibaba's numbers. I trust Alibaba's numbers. I'm not looking at his valuation. I have no idea what Charlie Munger believes about the valuation of the company, but that's just the way I look at it.
Jimmy, what were your thoughts on we hear a lot about this. People should be more careful. They're worried. A lot of comments in our videos. So I'm never investing in these Chinese companies. Did you get any of that pushback on your channel, or what are you thinking?
Some pushback, and I agree that there is some added risk versus investing in a company that's trading out of the U.S. or legitimately trading out of the U.S. I do agree that there's some risk there, which is why I personally own Alibaba and I've limited the position. I'm not going to grow it despite the fact that the stock keeps dropping. I wish I had been a bit more patient. I wish I was buying it today, but overall, I agree with Paul. I think that the odds of China, I thought it was interesting yesterday, that whole Evergrande thing came out.
Yeah.
And Alibaba was down pretty big yesterday. At one point I saw it down 5 or 6%. And I thought the implications of that was the opposite. Think about China, think about what they want to do. And even if they look out for themselves, even if they only look out for number one, well, if their real estate is in trouble, shooting Alibaba in the foot doesn't make any sense. The US markets are too big to be able to raise money over here. I think that it is their smartest move not to shoot themselves in the foot, leave it here. Plus, if they ever did shoot themselves in the foot, let's pretend they stopped letting Alibaba trade over here, or they did something super restrictive that people wouldn't invest in anymore. What's the next Chinese company anybody invests in? This is the best company to ever come out of China. This is the one everybody wants to make money on. If a lot of people make a lot of money, if this stock goes up to $400 or $500 a share, next time a big China company is out there, one, China will be more likely to let it stay, and two, people will be more inclined to invest. They're coming off the whole Luckin coffee. They're coming off that whole debacle.
Whatever, yeah.
Again, sinking the ship now doesn't make a lot of sense in my mind.
What we'd like to do in this video is take a look at the financials behind Baba. If you've never seen this before, we welcome you in to Everything Money, and of course, Learn to Invest. We'd like to use our software to look at the financials of Baba. This is a very rare point in time for us value investors where the company is going in an upward trend. However, the ticker price is going drastically downward, and we'd like to teach you how to separate the two, and we'll show you why this is what we think is a very nice play as a value investor. Go ahead, Paul. Get into it, baby.
So guys, they recently hit 320 and now they're down to 150. Let's just put this in perspective here. If I was right here telling you the stock isn't worth 320, you'd all be calling me crazy. You'd be sitting there saying, Paul, what the heck are you talking about? This thing is killer. Look at the last, okay, great. Look at the past here. This was 210. This is 135. These drops happen. That's a big drop, guys. How quick was that? That was, what, 6-7 months on the high side and it dropped 30%, 35%. You got to remember these things as time goes on, that these things will happen. So let's get back to the numbers here. Market cap, $410 billion. 5-year PE, 24.89. It's an X because we want less than 22.5, but this is a fast-growing company. You should be willing to pay more for it. Return on invested capital over the last 5 years, 10%. Last year was 18.8. So they're doing a great job investing their capital. 5-year average free cash flow, 18 billion. Last year they did 33. So they are growing like crazy. All right. Let's look at that growth.
Pillar number 3 is revenue growth over the past 5 years. I'm sure it's astronomical.
27 billion to 119 billion.
Oh my God.
Yeah, it's a 4 times larger company, guys, than it was 5 years ago. Net income, 7.8 to 22.9. Tripled its profit. Incredible.
What about those shares outstanding, Paul? Pillar number 5.
Now, the shares outstanding, they are issuing more shares, but not as much as I would think. 2.54 to 2.7. This is probably a testament to the fact that, and by the way, a lot of this can be attributed to diluted shares outstanding. These are the numbers of like options and things like that. I don't know if it's necessarily them saying we need cash because they're spitting out lots of cash. So I don't know if it's necessarily the cash, they're issuing shares on purpose to say, let's take advantage of this market. It might more be, we have a lot of executives, executing their options and things like that. It could be a number of things. So I'm not as worried about shares outstanding.
Jimmy, what do you think what are your thoughts on our pillar number 6, which is the average long-term liabilities, the total long-term liabilities divided by free cash flow? Do you use a metric of this in your evaluations? Like this?
I just do it usually what I'll do is I'll come up with free cash flow, discount that back to today. Okay, that's the value of the company. And then you adjust that for net debt. So how much debt do they have? Long-term liabilities, even short-term interest-bearing liabilities. And then how much cash do they have? Offset those, and that takes away from the value of the company. I think that's right in line with, if you've ever read any books on or listened to Buffett talking about the way you analyze the stock is if you're going to acquire the whole thing. That's the proper way to do it.
Well, in terms of how do you look at debt, long-term debt overall with the company in terms of risk? So our metric here is we have $17.8 billion in free cash flow. We multiply by that by 5. We want total long-term liabilities to be less than $17.8 billion times 5, which is what? $88 billion. Is that correct?
Give me a second. What is it again?
17.8 times 5.
89, Paul. You fool. You imbecile.
Okay, $89 billion. So I want all long-term liabilities to be under 89, because I want them to be able to say, hey, if we repeat the last 5 years, how long would it take? Would we be able to pay off all the debt if we needed to in the next 5 years? That's my idea. So 89 billion, I then go to the balance sheet. I scroll down. They have 36 billion in long-term liabilities. Yep. If they just do the last 5 years over again, just repeat the last 5 years, they'll be able to pay off all their long-term liabilities in a matter of 2 years. That's the way I look at it.
I think that's a great way of looking at it. You can also go one step further. I think one of the advantages of analyzing companies like this is, all right, let's say 88 billion is, you need it to be less than that. They have, what we say, 33 billion. If tomorrow news came out, Alibaba's issuing $20 billion in debt, right? They'll tell you what the interest rate is. They'll announce that whole thing. The stock will probably be down because of it. And I would sit there and go, and no, I know we have enough wiggle room, plenty of extra space. Don't worry about it. In fact, it's probably a good thing because if you're taking out that debt tends to be a low cost of capital. So you take out that debt, you grow the company. I assume that's why they're doing it, or make an acquisition or whatever. So that extra debt wouldn't bother me at all. But I agree. I think that's a great way of looking at it. And I think coming up with these numbers, doing that math before you click over to see what their debt is, makes a lot of sense because now you know where it needs to be at.
Yeah, and I think Jimmy does a more thorough job up front than we do. I like to start from a very, maybe I'm starting from the 500-foot view and Jimmy might be starting from the 200-foot view. We're both trying to get to the 50 or 100-foot view, but he does it a lot more. He's much more about doing it up front versus me. And multiple ways to skin a cat. We talk about how Peter Lynch owned hundreds, if not thousands, of companies in his portfolios, outbeat the market. Buffett believed early on you have 5 to 10 stocks that you know inside and out. I don't believe in that method. So either way, that's just a difference in opinion on it.
Let's get after free cash flow growth, the grandpappy of them all. This is a very important pillar for us, and Jimmy agrees this is one of the top metrics he looks at. So go ahead, Paul. Free cash flow, baby.
Okay, in the last 5 years, we don't have updated June numbers, but we have seen an average of $18 billion. There is growth from 10 to 29. So 18 billion times 20 is $360 billion. The market cap is 415. That's an X. Does this mean you shouldn't buy the company? Absolutely not, guys. You saw that revenue growth. China is the fastest growing middle class in the world. It's only going to get better for Alibaba. They are the Amazon of China. Nobody watching this video, if you're watching this video right now and you haven't bought anything from Amazon and you're in the US.
Something wrong with you.
I met one person recently who said that. He's like, I've never bought anything from Amazon. I'm like, what are you doing? Like literally, I'm like, how do you live your life? The same with Alibaba. It's going to be the same way in China. As their middle class grows and grows and grows, they're going to become more and more ingrained in that Chinese economy. I am a long-term believer in that. So I go to the stock analyzer tool after, we're going to go to stock analyzer tool now.
Yeah.
See our assumptions and go from there.
Jimmy, you were saying last night about Alipay. I saw an Alipay sticker at a Houston airport. You're saying that people over there, this is all they use in China is Alipay. There's no cash. Isn't that the story you're telling me last night?
Yeah. So I work with a girl who's from China. She actually just recently went back there, and she was telling me that everything is done through Alipay. They get paid. It goes into that account, whatever that account is, however that works. Everything they buy is through Alipay. And frankly, I actually think that's one of the battles that China is fighting is, from what I understand, China wants access to a lot of that data. Alibaba's pushing back on some of it. So I think a lot of the head fakes to, we're going to pull you off the exchanges and all that stuff. China, let's remember, China has let this happen up to this point. They have a rule about outsiders can't invest. They've allowed for it to happen. For them to pull that back, I think it's half posturing just to make sure Alibaba plays, with the government.
Yeah. If you like the 8 pillars, if a company falls into your 8 pillars, you can move into our stock analyzer tool. This is part of our software, and this can translate, Paul. Like once maybe we're in love with it, we can say, what should we be paying? This is the hardest thing for, I think, young investors because we just see a ticker price of 150 and. Paul, there's so many videos out there actually of like, there's videos about how to invest in companies that are under $5 or under $20. And we would like to teach you that really the ticker price has nothing to do with it until the final, to the end here, Paul. So show us what we're doing here, baby.
So I'm being more conservative. I don't know why. I had to start because of the fear. I think my big fear is, what if I'm wrong on this? So let's take it back. But I also want to show you my conservative numbers and how ridiculous they still turn out to be. Revenue growth. Last 5 years, they've 44.5%. I went to 20, 25, and 30. And I'm sure Jimmy's looking at that going, what the heck? I went crazy. Share change. I went 2.5, 1.5, 0.5%, just based on these numbers. Profit margin. 18, 20, 22. Same with the free cash flow margin. 18, 20, 22. PE and price to free cash flow. 14, 16, 18 on both. The reason being, it's a bigger company, but it still has a lot of growth potential for a long time in China because of the growing middle class. The average person in China makes $11,000 a year, but that's going to grow astronomically over the next 30, 40 years. They're going to grow faster than us. Accept that. It's not a bad thing. It's a good thing. And I did my returns of 15, 12.5, and 10%. Guys, look at this. Hit the analyze button all day long. All day long. You can justify paying $350 for the company today, and it's at $150. My lowest expectations are $185. It's at $150. I am going to be adding this portfolio. I'm worried I might want to buy more than 3% of my portfolio in it.
3%.
But I'm building a position. I'm selling puts. I love it.
Jimmy, your rebuttal about those numbers moving forward with Stock Analyzer.
Yeah, so my numbers aren't that far off. For revenue growth, I did 20%, 30%, 40%.
10% higher than Paul.
10% higher. I think that they have the potential.
He's right.
To keep going. Even there's the global aspect of what Alibaba brings to the table. They have many businesses that are business to business, more so than Amazon. And that could be, there's no reason they couldn't keep expanding that. So I think that potential is huge. Share change, I went a bit higher than you did.
Oh, wow, you did.
I did 6%, 3%, 0. on the high end, I guess. But I think it's tied to this. I think the way to grow is to raise capital. The reason I think that they will stay listed on the exchanges is because they want access to the capital. How do you get that capital?
Can I respond to that?
Yeah.
They have so much cash flow. I don't think they need the capital. That's why I kept it low. They don't need that capital. Their cash flow is insane. By the way, I'm glad Jimmy went conservative. But I look at it going, they have so much cash flow. What do they possibly need to raise more equity by issuing shares? That's my reason why I don't buy it. I don't believe 6%. And to be honest with you, I think it can very well just be zero for a long time because their cash flow is so incredible. But go ahead.
Yeah, so 6% is undoubtedly conservative. And I agree, it could stay at 0%. I don't think they're going to buy back shares. In fact, I would be surprised. All these assumptions would have to change if they started buying back shares, because that would tell me that they don't know what to do with their cash.
Yeah.
And that's a different problem. Profit margin, so these were a bit tricky. I had 15, 20, 25 for both profit margin and free cash flow as a percent of revenue. Frankly, those are very large windows. I didn't really like having a window that large, but I don't think that they know yet. I think that if we scroll down a little bit to the PE, they have a PE of, call it 18, a price to free cash flow to 12. Again, I kept those numbers the same, 15, 7.5, 20. But I think that those are going to come together. The fact that their free cash flow is lower now makes sense. Most faster growing companies have lower free cash flow. 7 years from now, which is what this projection is, 7 years from now, that's likely to normalize and come closer together. So I think it makes sense to, say that they're going to be, I don't think it's going to be at 12. Did I go higher? Okay, yeah. Annual return, 15, 12 and a half, 10. So one difference between what you guys do here and with this analysis versus what I do on the channel, on the Learn to Invest channel, is that this 15, 12 and a half, 10 is sort of, I've baked in my margin of safety into that. So on my channel, I'll project free cash flow going out, discount it back to today, come up with a number. Oh, it's worth $300. And then I add a margin of safety to that. I could be wrong. They could get delisted. I recognize I don't think they will, but it's a possibility. Well, with that, I'll say, okay, let's add 20% margin of safety, whatever the number is. Everybody should have their own, based on their own confidence in the research, but you add a margin of safety. These are much higher. I usually use 7.5% as a required rate of return and then add a margin of safety. It'll probably get it up closer to the 10 or 12% range. But these are baking it right into it. When we hit the analyzer, stock's currently at $150. Yeah, that's a huge window. So the stock is trading here. That's what you get when you say they're going to grow by 25% or whatever.
40%. You did 40% on the high side.
Yeah, I do think that over the next 7 years. The other question with this is that I assume this is an average.
Yeah, so it's 40%. Okay. Yeah, it's just 40% a year over the next 7 years.
Yeah, so I would not be surprised if they had big growth in the next 2 or 3 years, and that will taper off as the larger they get. And yeah, so overall, I like Alibaba. I already bought it. My average price is $177.60.
I think I'm pretty much exactly there.
Yeah, $177.60. I'm not buying more down here. I'd love to be buying more, but I'm not buying more.
Why not?
I just don't want my position to get any bigger.
I want my position to get bigger. I'm buying more and selling puts. I'm buying more today, probably.
Yeah, I don't want this particular holding to dominate my portfolio because there is risk to it, and there are risks that I think are very unanswerable with a very volatile group of, organizations involved. So a lot of things could go wrong, but in the meantime, for a smaller position in my portfolio, I'm happy to hold it and let this thing play out. And the fact that it's down doesn't bother me right now. I'm okay. Yeah, maybe I should buy more. If I got some extra capital, then maybe I'd, increase all of my positions a little bit. But overall, I love the stock. I think the potential is huge, and the fact that on the low end we're nearly there, I think I personally look at this number. I think this is the most important thing. That's just a little crazy. Let's get rid of that.
And mine's a little bit tighter, but and overall, look, his middle number is 447. Mine's 354. Who's right? Who's wrong? My low number is 185. His low number is 130. It's just my high number is 675. His is 1400. I don't know. The point is, There's very similar aspects to how we look at this company and how we use the stock analyzer tool.
Go to Learn to Invest on YouTube. Make sure you subscribe to Jimmy. Jimmy's coming out with a Patreon in the very near future, so you can join his community as well. And that was it, boys. I love it. We love this company, both of us. And it was great to hear both of you go back and forth. We will always update you with our thoughts on Baba, especially if it keeps tanking, which we thoroughly enjoy, Paul. You know this. So, Jimmy, thanks for your insight on Baba. And that's our take. Fondle thumbs up on the way out. We'll see you guys in the next video. Thanks, Jimmy. Appreciate it, man.